Welcome everyone. My name is Sam Gray. We have Pat Riley and Mitch Gilbert, and we are representing the University of Portland. Pretty much we do our review of lithium motors. We have an executive summary. New York Stock Exchange, ticker LAD. The current price, at least as of close of yesterday, was $92.72. Our target price is $89.50 with a downside of minus 3.6%, and our recommendation is a hold. Pretty much we feel pretty strongly with the combination of acquisition and growth. They have a good record in executing their business strategy, diversified cash flows with some room for internal improvement. Then they also have the ability, demonstrated ability to weather economic slowdowns, which we also find as a positive. Some things that slightly concern us is a slowing growth rate. It's a very competitive industry, and some concerns about their future working capital and how they relate to their debt covenants.
Okay, so now if we look at Lithia as a general overall company, they're a consolidator. They're in a consolidating industry. They're trying to grow through acquisitions. They're entering new markets through acquisitions. Based on the number of acquisitions that they have identified in the U.S., we don't expect that to cap them anytime soon. The other key aspect of their business model is they have 4 streams of cash flow that somewhat provide them diversification and some recession buffer. So in 2008, when the equities markets had a huge hit, Lithia did okay, mostly because their service and parts aspect grew and sustained them. Moving on to looking at them as a whole in the US, they added DCH in October of 2014. They are branded as Lithia and as well as DCH. 135 plus dealerships in the US, 15 states now, 14 on their financial statements, 1 just added in Massachusetts. But you can see that really 5 states are the key drivers of their revenue. California, Oregon, Texas, and New Jersey. That's 4 that can count.
So as an industry overview, Lithia is currently one of 12 companies that operates in the automotive retail sector. The majority of the 17,800 dealerships that operate in the United States are primarily owned by private, smaller dealerships. An interesting fact is that the 10 largest dealership conglomerates in the country only control 7% of all of the dealerships in the country, meaning that there is a lot of opportunity for Lithia to continue growing through their strategy of acquisition. The U.S. car sales versus GDP indicate that Lithia, because U.S. car sales are growing at twice the rate as GDP, it shows that Lithia has the opportunity to continue growing organically through new car sales. And as the age of U.S. automobiles increases, there grows increasing likelihood that the U.S. fleet will choose to turn over its older vehicles into newer vehicles, acting as a revenue driver for Lithia. From a competitive positioning standpoint, Lithia is sitting pretty good. As far as other key statistics go, they're usually above the mean of all their major competition, or right at the mean. However, it's important to recognize that Lithia's primary competition comes from smaller private dealerships that are in their areas of operation. So for Porter's 5 forces, we have 2 points of emphasis. One of those is the intensity of competitive rivalry. There's a lot of competition in this sector. A lot of the private dealerships operate in the same areas as Lithia and sell the same makes and models of cars on their lots as Lithia does. Another is the bargaining power of suppliers. Lithia's performance is largely dependent upon the ability of manufacturers to deliver the new cars and new part inventory to them if for some reason there was a fractured relationship with the suppliers, or the suppliers for whatever reason weren't able to provide high quality products that could affect Lithia negatively. One last issue is the corporate governance structure. Lithia Holding Company is predominantly owned by former CEO Sidney B. DeBoer, who currently controls 52% of the voting shares of Lithia Motors. This presents a potential issue to shareholder rights, given that Sidney DeBoer has a controlling interest in the company.
Okay, now when we got to our financial analysis, we really built all our future projections on 2 key assumptions. The first one was that the DC acquisition is a unique acquisition, at least in the short term. It was over 50% of the on a revenue basis of Lithia itself. We don't expect them to do that in the near future. Secondly, when we looked at the pre-DCH acquisition time period between 2010 and 2013, we see extreme linearity of key balance sheet and income statement categories. So using a linear forecast, we projected these categories into the future. That's built or without DCH model. Then we calculated and approximated the DCH impact based on the 2014 10K and the third quarter results for 2015. We compared those results to some published values, especially specifically revenue, and got within 10%. The quoted published values or estimates based on the industry was a little bit more off from what we expected based on earnings per share basis. But then, so we used those key assumptions, built our model, and looked at what kind of came out of it. On a revenue basis to begin with, now that the 10K is out for 2015, our projected 2015 revenue was within 1% of the actuals for 2015. Our model projected or predicted that net profit margin in 2015 would regress and then slowly head back up in the near future. The actuals for 2015 showed a net profit margin drop in 2015, less than what we predicted, but it's still there. Looking at the historical and projected free cash flows and year-on-year growth for the free cash flows, which are more random and or more noisy, we can see that we have a bigger difference in free cash flow, but it was partially due to what them trying to help their covenant. And then on an EPS setup, we under projected the EPS by about 10% for 2015.
This is the last part of the financial analysis is looking at their debt, particularly their credit facility. Pretty much in 2014, they had a waiver for the current ratio because it fell just below. In terms of 2015, they actually had that current ratio number reduced from 1.2 to 1.1. And if we look at the line 1.1, this is the actual and forecasted current ratios. And if something doesn't change, I mean, we are forecasting them, or if the linear growth continues, they will fall below in 2016 unless something happens. And the second here is, this is actually the predicted working capital they would need to maintain that debt covenant. And the blue line, again, is our forecast of where they're headed in the future. Pretty much, unless they find a way to increase cash flow, they're going to be looking at about a $600 million spread between where they need to be and where they're, for the debt covenant and where they're going to be, which is according to our forecast. And pretty much they would need to want to increase organic growth or add cash to the long-term debt, just to bump that number up and maintain. And we fed these numbers into our valuation model. Pretty much we use assumptions based on the Russell 2K. So our beta and our risk premium is based on the 2K. We fed that into the weighted, calculated the weighted average cost of capital. And that, the only real difference is we only use the long-term debt. We treated the debt covenant, the short-term debt, as primarily as working capital. So we fed it into the model as a three-stage discounted cash flow model. One for 2015, just to account for the increase from DCH. Then we ran 2016 through 2020 steady state, and then ran a perpetuity. The big thing here, we also ran that assumptions through a Monte Carlo. High confidence in the mean, as you can see from the spread. They're very sensitive to the perpetuity, which means it's just that has ability to affect the price, as you can see by the dramatic spread in this bottom table.
So from a risk standpoint, we see four major risk factors, one of those being regulatory risk from environmental health or safety regulation, such as Oregon tax initiatives that would add a 2.5% tax to all income over 25 million. There's also the operational risk from their dependence upon the supply chain. We also see substantial credit risk because of their business model depending on credit availability for themselves and their lenders, and also substantial market risk because of their reliance on secondary markets and their vulnerability to economic downturns.
final, in conclusion, our recommendation as a whole, based off our target price of $89.50, which represents a slight downside from where they are now. Pretty much, we like a lot of what we see in the company. We think we like their business strategy, their business model, how they're executing it. They're growing revenue, their car sales are looking positive through the next year, strong earnings. Pretty much, we are concerned about the slowing rate of growth associated with being very linear, and pretty much how ultimately the working capital is going to affect the debt covenants going into the future and their ability to raise additional cash or additional current liabilities. And there are some issues with ownership structure. I know there are some lawsuits now, just about whether there's too much control from the family relative to the public corporation. But then I think to move above a hold, we would really need to see continued growth or acceleration of the growth rate and really be more optimistic in our assumptions going forward. Thank you.
I'll go, and I had the liberty of reading your written report ahead of time, and there was a section on a dividend discount model which came up with 49.12, and that was really way off from your 89 and your 90 from your other methods. What happened to your dividend discount model?
We looked at it in terms of just did a linear trend based on what they've done in the past. I mean, the model, if you look at historically, it's R squared 0.99. And I think, because they're using a lot of their cash, a lot of their earnings to fuel acquisition, they're not putting it into the dividend. So we really didn't think that accurately reflected the value of the company. So we didn't end up using it for our target price.
Can you comment about the consumer and the outlook for auto sales, given the price of fuel and where we are in the interest rates, the outlook for the economy, just kind of the behavioral of the consumer right now, their appetite for cars, and where we are in that replacement cycle?
Mm-hmm. Well, I mean, the major point with the fuel prices is that the low fuel prices will continue to spur consumer spending, and so people are going to continue to see cars as a viable investment with low fuel prices, which only continues to benefit Lithia's revenue growth looking into the future, and hopefully as U.S. GDP is showing steady rise, so there shouldn't be any significant downturn in that I would expect. So looking forward with the low fuel prices, it really does benefit Lithia.
And to add to that, the average age of the vehicle on the road has increased since the downturn in 2008. It's continued to grow. It's at pretty high levels comparatively to past or normal levels. So we expect more. At some point, buyers are going to have to buy replacement cars if they're going to continue to drive on the road.
There's also an increase, if I read this correctly, of the used car. And it's not all new. It's not all new car sales, but used cars, which have higher profit margins. And can you comment on that part of the source of revenue?
It is a significant portion of the revenue. I think the stat from the quarterly presentation, I think 70% of their used car sales originate from new cars. So they are independent. They're not entirely linked, but they are closely correlated. So as I sell more new cars, that brings more new used cars into their inventory to sell.
It's also a huge initiative by Lithia, at least self-stated, that they want to increase their used car sales by even to the point where they're buying wholesale used cars instead of selling wholesale used cars. But we haven't really seen any evidence of that huge growth. It might be in their 2015 10K, but it came out Friday and we haven't digested it.
So thinking about what you know about the business and the different segments and how the profitability characteristics are between those segments, what would you think, and how would it change your investment thesis and your model assumptions if the company announced tomorrow that they were going to exit or sell their service business?
It'd be a huge red flag for us. It provides from a basic standpoint, it provides a steady, constant customer contact. They're more likely to retain their consumers if they're seeing them every quarter, every 5,000 miles for service. On the flip side, it also adds them some recession hedging. So when it goes down, economic downturn, people aren't buying, but they are trying to maintain older vehicles, and that improves the service. in fact, the CFO, we asked him a question about whether or not a recall is a bad thing for them, and essentially it's a great thing. They get huge bonus from new car sales by bringing all the customers in, touching their vehicles, having that customer contact. So it would be a huge red flag if they were to miss that.
Speaking of good and bad things, you, by your own admissions, cited Texas as being their largest market. Is that a good or a bad thing?
Well, right now, I would say that it's not a particularly good thing. I mean, their economy is struggling with low oil prices. But it's still, I mean, it was 20%, I think. So while it is a significant portion, I mean, that's not all going to go away. They have enough revenue coming from other sources where, I mean, it's not going to tank the company. They're likely to see some revenue drop from that. But I think largely, if we look at last week, oil has somewhat stabilized. We may have found a bottom, and hopefully, as that picks up, Texas will remain, will be able to grow.
So, just recently, Lithia was sued by a shareholder, and I think you kind of alluded to that. And obviously, we wouldn't expect that to be in your report, given that it came out pretty recently, probably right around the time that these reports were due. But what I'm curious about is, based on your analysis of the corporate governance, were you surprised that this was able to happen, and that they're being, you know, the lawsuit is that they're going to basically fund an annuity for their retired executive chairman? It's a pretty substantial amount of money. Are you guys surprised about that? And if so, why or why not?
Well, I didn't feel particularly. I don't think we felt particularly surprised by that. Mostly because while we were digging through the 2014 10 case, we found that interesting fact about the Lithia Holding Company and Sidney DeBoer's control of the voting shares, and so we haven't seen the payment of like the consistent payment that he's receiving from the company as like a retirement severance package, but we did see the voting shares issue and saw that as a potential problem from the standpoint of shareholder rights. And so when the lawsuit came out and Sam emailed it out to us and we saw it, it was kind of like one of those moments where we were like, okay, like we kind of saw this coming, kind of a pat yourself on the
Makes
back
sense,
moment.
yeah. Yeah, it was one of our key risks in the report, and we mentioned it again today, so not that surprising.
Yeah.
Look, it's a very interesting combination of being a public entity yet still a public and yet a family company at the same time. So ultimately, family still can replace the entire board if it really felt like it due to its voting shares. So I mean, it's a risk you inherently run when you have that large a stake.
The New York Times wrote some pieces last year about the securitization of auto loans. Can you make any comments about Lithia's exposure to that, either ill will or direct contact?
Well, as a percentage of the revenue, it's a relatively small portion, although it's a very high profit margin on it. So it is important to them, as I know it's a revenue source they're looking to grow. I know my understanding was from our conversation with Chris Ozu is they are in and out the door. I mean, they're literally the middleman, and they pass them on with very little effort, as far as I was able to gather. They do hold some of the riskier loans in-house. I think that was $5 million, the average about 5 years total. So I mean, some of the, I guess the worst, they do have to hold in-house.
Yeah,
it's a relatively small share.
We focused on that really early on because of the, if you look at like Countrywide, for example, the way they died was by holding too many subprime loans, and then when it crashed out, they had too many on their books, essentially. And in a lot of ways, Lithia is an originator for subprime loans for auto. But we were looking at how long they stood on their books, and it's about 90 days or so is what we found, approximately. So they hold them, sell them, the majority of them, so it's not a huge impact at this point, but it can be very concerning if they start holding more and more of these loans on their books, which won't necessarily be obvious to the stockholder in an effective and quick manner. is you could essentially grow or sustain your own growth during an economic downturn by just keep writing loans and holding them on your books.
1 minute.
So on your financial analyst page, the financial analysis page where you were talking about trends and you had a bunch of lines and you called it linearity. What is linearity?
Pretty much just looking at especially the balance sheet, income statement, I mean, they're perfectly linear trends. And pretty much the assumption we made was, yeah, there's big input from DCH, and that same linear trend would continue on
My
top.
point is more technical. You know, we're gonna send you out to Chicago. I looked up that word, I don't see it in the dictionary anywhere.
What we mean is that the coefficient of determination, the R squared,
I don't
which
think
just
the word
gives you a,
says.
yeah, but it's a general term of like,
My point is, we're gonna send you
Okay.
up to the best and the brightest in Chicago, and if someone like me were to look at that word up and not see it, they'd wonder where'd that come from. I think the word is linearity.
linearity, thank you.
Done.
Yes.
All right, thank you,
Okay.
gentlemen. Good job.